Welcome to this explainer. If you've got financial interests outside of Italy, you already know the tax codes can feel, well, kind of like trying to solve a giant puzzle in the dark. Today, we're turning the lights on. We're cracking open the detailed findings from the F.D.T. Consulting Tax Report to break down exactly what you need to know. So let's just address the elephant in the room right off the bat. The sheer overwhelm and confusion a lot of expats and Italian residents feel when managing foreign assets. It's stressful, right? But honestly, it doesn't have to be. By understanding a few core frameworks, you can manage your wealth confidently and completely avoid unnecessary penalties. To make sure we're sticking strictly to the facts, we are pulling all of our insights directly from the Comprehensive Tax Report by Dr. Francisco Di Tommaso. We'll be focusing specifically on the rules governing tax monitoring, the IVAF wealth tax, and interest taxation as they apply to the 2024 and 2025 tax years. Here's our roadmap to tame the chaos today. We are going to quickly cover the Form RW obligation, the crucial split between accounts and investments, how the IVPUF-WAP tax works, the 26% rule for income, how to find tax relief, and finally, your compliance checklist. Let's get right into it. Starting with Section 1, the Form RW obligation, which establishes the absolute foundation of the tax monitoring framework. Okay, the absolutely crucial point here is that if you're a taxpayer resident in Italy, you have to declare pretty much everything held abroad on Form RW. We're talking standard foreign current accounts, savings books, bonds, ETFs, mutual funds, foreign financial policies. Literally any financial asset held abroad falls under this umbrella. And here's the real kicker. This obligation exists regardless of whether these assets actually produce any income at all. Just holding them triggers the reporting requirement. Moving to Section 2, accounts versus investments, the crucial tax split. Tax law is all about definitions. You absolutely must separate your financial holdings into two very distinct buckets. Bucket A contains your foreign current accounts. These are your ordinary bank accounts, payment accounts, and savings accounts that might kick back some interest or bank bonuses. Bucket B, on the other hand, contains your foreign investments. Think stocks, bonds, ETFs, mutual funds, SICAV, asset management, stuff producing dividends or capital gains. You have to draw a hard line between your everyday payment accounts and your actual investments, because Italy taxes these two buckets entirely differently. Which brings us to Section 3, understanding IVFA taxes, or basically the actual cost of holding your assets. Let's look at Bucket A first. For those foreign current accounts, the IVAF is a fixed flat rate. It's exactly €34.20 a year for every single current account you hold outside the country. But wait, here is a fantastic piece of vital relief. That €34.20 flat tax, it only actually kicks in if the average balance of that specific foreign account goes over €5,000 during the course of the year. If you keep the average balance below that threshold, you do not owe the fixed IVAC amount for that account at all. And this perfectly illustrates the underlying logic here. As the F.D.T. Consulting Report points out, the IVFA for foreign current accounts operates substantially just like the standard stamp duty you'd naturally pay on a domestic account with an Italian bank. It's basically just leveling the playing field between domestic and foreign banking. But things change completely when we look at Bucket B, your foreign investments. Here, the IVFA switches from a fixed flat fee to a proportional 0.20% per year based on the total value of the investment. So to put that into perspective, an investment of €50,000 results in a €100 tax. A €200,000 portfolio, that generates a €400 tax. It scales directly with your wealth. All right, Section 4, the 26% rule. This is all about taxing your foreign income. So we just talked about the cost of simply holding assets. But what about the money those assets actually make? Under Italian tax law, any interest accrued on foreign current accounts or deposits, like, say, a French savings account, must be declared. And that interest is hit with a flat tax rate of 26%. Meaning if you get €1,000 in interest abroad, you owe €260 to the Italian tax authorities. Now, the real catch here is that this 26% rule isn't limited to just basic interest. It applies uniformly across almost all of your Bucket B investment profits too. So whether you're earning dividends, clipping bond coupons, realizing capital gains from selling off securities, or taking profits from mutual funds, you should expect that exact same 26% substitute tax to apply across the board. Let's move to Section 5, Credits, Deductions, and Losses, Finding Tax Relief. I know tax rules can feel incredibly punitive, so let's talk about the relief that's actually available to make sure you aren't suffering from unfair double taxation. Thankfully, if a foreign bank has already withheld taxes on your earnings, Article 165 TUIR steps in with a foreign tax credit. Let's walk through a quick scenario. Say you get €1,000 in gross interest, and a French bank already withheld €128. Normally, your Italian tax at 26% would be €260, but thanks to the credit, you subtract the 128 you already paid in France from that 260, which means your final bill in Italy is just €132. See, you don't pay twice. And there's more good news when it comes to deductions. When you're calculating your taxable financial income, you're absolutely allowed to deduct specific transaction-based expenses. We're talking about commissions directly tied to buying and selling financial instruments, brokerage fees, trading costs, and recoverable foreign taxes. All of these help lower your overall taxable burden. The bad news, though, standard operating expenses are strictly non-deductible. So you cannot deduct current account fees, account maintenance fees, foreign stamp duties, or general administrative and credit card fees. Basically, ordinary bank management fees just do not count when calculating the tax on your financial income. There is one more really critical rule for investors highlighted in the report. If you take a hit in the market and realize capital losses from selling an investment, those losses aren't just wasted. You can actually use them as a shield to offset your future capital gains. And under current legislation, you can carry those losses forward for up to the next 4 years. That is a huge relief. Finally, Section 6, your documentary checklist for proving your compliance. Because knowing the rules is really only half the battle, right? The other half is proving it. The F.D.T. consulting report hammers home that maintaining proper, well-organized documentation is the absolute bedrock of correctly monitoring your assets in Form RW. Without a strict paper trail, you literally cannot claim those credits or justify your math to the authorities. To guarantee you can actually claim your foreign tax credits and clearly prove your IVFE calculations, you need to keep this exact checklist of documents safely filed away every single tax year. You'll need your annual account statements, official foreign bank certifications, certificates of accrued interest, and, crucially, certificates of any tax withholdings you've already suffered abroad, along with your investment and annual tax statements. Thank you for joining this explainer. As we've seen, the Italian tax system for foreign assets is definitely thorough, but it is also highly structured and predictable once you know the ropes. The tools to avoid double taxation and properly categorize your wealth are completely in your hands. Don't let the fear of foreign tax compliance hold your global financial strategy back. So I leave you with this. Knowing the hefty price of a simple mistake, are you absolutely certain your foreign assets are safely separated and perfectly documented for your next Form RW, or are you leaving yourself exposed?